want to get right to Jeffrey Kleintop, Schwab Chief Global Investment Strategist. Always good to see you here, Jeff. So you've digested, I assume, the jobless claims this morning, and we've seen the market sell off a little bit. What's your take on it? You think now is the time where investors should be raising a little cash?
Well, I think that this is, 10 million in claims in 2 weeks is absolutely a huge and shocking number. The question now is whether those stimulus programs targeted to small businesses can kick in right away and begin to stem this huge surge in unemployment. You know, if we continue to see something at this pace, the degree to which the unemployment rate will climb is just going to be astronomical. Obviously, we don't know how long this is going to last, but we do need to get that in place to avoid mass layoffs. We also heard from Challenger this morning on their job cut announcements. Those were up 266% in the month of March. We've barely begun to feel that yet. So it's very important to contain this, and one of the ways we can do that is hopefully with this small business program targeted at those businesses where they're being forced to cut jobs.
Jeffrey, when you look at these disastrous numbers and the expectation is they're going to stay bad for some time, what do you do as an investor? I mean, has the market, you think, discounted the fact that the bad news is coming and it's not going to be good for a while, or are we going to retest those lows?
I think the market has digested the fact that this data is not going to be good. The question for the markets is how long is it going to be bad? We're kind of in this limbo mode of just not knowing how low it's going to go or how long. You know, what we've seen is South Korea and China have gotten past their peak and resumed economic activity. Italy now appears to be a week and a half or so past its peak in new cases. Perhaps in another few weeks, they could consider resuming more normal activities. If that's the case, if that's the pattern that now Europe follows, and then we see begin to affect the U.S. in a month or so, then I think the markets have properly discounted the risk here of a sudden shock to economic activity, but one that's relatively short in duration. If it looks like it's going to go a lot longer than that, well, there's probably more downside.
Hi, Jeff. It's Heidi Chung here. So we've had a lot of experts say that it's not a matter of finding the bottom, but there are in fact in bear markets a lot of bottoms. And so we've seen the market try to bounce off those lows and break out, but of course it failed that breakout. So in this kind of situation where we're expecting many bottoms, when is it safe for investors to sort of jump in if they've been waiting on the sidelines? At this point, is there even a reason to wait around?
If we look back at the history of pandemics over the last 50 years, and this is definitely an outlier, but if we look at them, what we see is that the markets began to definitively bounce once we saw the peak in new cases on a global basis. Of course, we don't know when that will be, but we can look to the models that we've seen in, again, China, Korea, maybe now Italy, to kind of give us that sense. So markets initially bounce on stimulus, then they retest those lows usually as we get to that peak in new cases. Again, no one knows exactly when that will be, but that would typically define the turning point for the market.
You know, Jeff, starting to see a shift on Wall Street and how the economy might play out into year end. A couple of folks have suggested to me we might see negative growth going into the end of the year. And that is a big change, I think, in sentiment and forecasting, where a lot of folks have been looking for growth to resume in the fourth quarter. What are your estimates looking like?
It's just too early to say. We just don't know. I mean, again, hopefully we're seeing these peaking cases and that will result in some return of economic activity. But we just don't know. I think investors now are beginning to get concerned about dividends, right? So many investors are focused on income. They weren't as concerned about the price drops, but now that they're seeing companies focusing on dividends, though they may be cash rich, worried how long this might last, that could put at risk those key dividend payments that many of them depend on. I think that has, at least yesterday, I think contributed to the selling. So that's a concern about the duration of this downturn beginning to affect a new class of investors.
You know, this is so different in so many ways, right, Jeffrey? This recession, I guess you can call it that, we're in now, and it is global in nature. And usually, when one asset class is not doing well, there's something out there that's doing okay, and so people gravitate to that. Are you seeing that right now? If people want to stay away from global equities, where are they going?
Yeah, not really, no. I mean, treasuries have done okay. Here's one of the few safe havens that investors have been able to go to. One of the reasons why it was important to rebalance back towards bonds and portfolios at the end of last year, one of the key messages of our 2020 outlook. But no, there haven't really been any safe havens. I think investors at this point, rather than looking for safe places, may want to look for, where are the leading indicators going to be? Where are the areas of the market that might bounce first when we get to that point? I think one of those areas might be emerging markets, might even be China, ground zero for the virus outbreak. That's an area that now has obviously recovered from its peak in virus cases, recovering in economic activity. We saw that in its PMI report this week, huge rebound there. But even more importantly, emerging markets, including China, have led the rebound in the past two global bear markets and recessions back in 2000 to 2002, 08, and 09. I know finding parallels are difficult here, but it's interesting to note that emerging markets have led the recovery 6 months before the rest of the market in the past two downturns, and may again be signaling something this time with their better performance in recent weeks.
Jeff, you mentioned dividend risk outside of the oil patches, which has been absolutely hammered. Where else do you see dividend risk? I think a lot of investors have been trained to expect that, hey, dividends only go up.
Yeah, well, we've heard some new cut announcements from the banks recently, particularly in Europe, HSBC, a few others, focusing on how much cash do they need to keep on hand. And I think that's going to be a concern. There have been a number of sectors. Yesterday, for example, it was utilities, it was financials that really kind of led the sell-off. And that's unusual in a market that's moving to the downside, that you get these defensive areas. But it really was about those dividend yields and concerns there. So I'd say financials are the new bigger concern for markets as they worry about the duration of this downturn and the hit potentially to those dividend payments. And again, I don't think we're going to see mass dividend cuts, but we've already seen that with buybacks, and dividends would be the next step.
Jeff, what do you think is going to happen tomorrow as you look into your crystal ball and we get that monthly unemployment report, which, by the way, is not going to really truly mirror all of the damage because it'll be the month of March and things weren't locked down to the extent they are now back in March. But do you think that this market, we're going to see another huge sell-off or perhaps maybe, dare I say, a relief rally, even if the number is disastrous?
I think the market might write off the number tomorrow as a lagging number, and the initial jobless claims number that we get today, that we get each week, as more of the leading indicator. One of the things I think that might cause some bifurcation in markets is that in Europe, we're just not seeing the same rise in unemployment claims numbers. We got the Spain numbers and Ireland numbers today as well. And we just don't have, we have a much different social safety net in Europe than we do in the U.S. Unemployment rate just doesn't surge to the same degree. And if we see more stability in the labor force, in consumer spending activity in Europe versus the U.S., it could cause maybe some emerging bifurcation in the markets if more of the attention is focused on jobs.
Jeff, do you think it's right? A lot of investors are looking at a budding recovery in China and trying to use that playbook for what could happen in the U.S. and might be taking positions on the long side because of that?
Yeah, obviously there are big differences, right, in terms of the size, the scope of the shutdown of economic activity, the quarantining taking place. And so I think there are some lessons that can be learned, but maybe a close parallel isn't the perfect example. The U.S. is full of many, many different cities, many different areas that don't act with the same maybe federal authority oversight that we saw in China. And as a result of that, could be a longer tail to this pickup in cases than what we saw in Asia.
All right, let's leave it there. Jeffrey Kleintop, Chief Global Investment Strategist at Charles Schwab. Always good to see you.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.